For tuning into the Land and Home Show. Today we are doing another market update, specifically all about these crazy interest rates. All right, hey, I'm Stephen J.B. Davis, your land specialist and residential realtor here in Central Kentucky and beyond. Wait a second. I need sunglasses. Anyway, today we're talking about interest rates. I wanted to make this video yesterday, but I was traveling and I hate recording on my laptop, so I had to wait till I got back to Kentucky. Yeah, so this video applies to you if you are a soon-to-be seller or soon-to-be buyer, because a lot is changing and in a crazy fast amount of time. Like, let's just start with fact. I'm gonna basically try to keep you on, objectively what has happened, the interpretations I'm hearing from lending and like mortgage originators, lenders and mortgage originators, and then my own, I guess, professional advice about how that applies to Kentucky now, because at the end of the day, markets are local, and in all of the craziness, I think a lot of people are forgetting that. I've said it before and I'll say it again. In 2008, when the market crashed in this historic crazy way that it did, there were still big cities that were virtually untouched. So what you should do if you're watching from a city or an area that isn't Central Kentucky, it may be something different than what I recommend by the end of this video, and you need to be aware of that distinction. It's a very important distinction. My suggestions are based on what's happening here, not what's happening everywhere, even though I'm, I guess, reporting about things that are affecting home buyers and home sellers everywhere. The action that you take after that news, it will completely depend on where it is you are in the United States. So, facts. So yesterday, September 26th, interest rates rose 2 times in a matter of hours. And so the fact that they rose, of course, is already like, again, like, who wants that if they're looking to buy a house? And frankly, if you're looking to sell it, because there's some stuff in there for you too, sellers. But interest rates rose 2 times. Kind of unheard of. And because of that raise, or that hike up, or whatever, this is the Federal Reserve. So just so you know, that the Fed Reserve is not a branch of the government. They're not even really a government body. They're appointed people, which I know is kind of crazy, that speculate and look at objective things and look at different types of commodities and markets, and then they say, okay, how can we induce inflation or correct the market, or do any number of things. They have a lot of control over economics here. I mean, that's my personal opinion, but whatever. Before we get too political, so the Federal Reserve raised the interest rates 2 times yesterday. And so what that meant was lenders virtually everywhere in this country, in the United States, took a plan of action. And I was in the middle of this with actual clients yesterday, where they were getting to lock in their interest rate for a home that I helped them get under contract for. But the only thing that their lender was telling them was, if you give us X amount of dollars, then you can have an interest rate of X%. So for example's sake, if you give us $7,500, then you can have an interest rate of 6.2%. This kind of thing is called a buy down. Now, it is something that some borrowers have to do when they don't get the interest rate they want, and they don't have like the most tip-top credit to get that best rate, so they will buy down their rate. Sometimes you'll hear people say, by points, because you consider each percentage a point. So this is not an uncommon practice on its face, but it is completely unprecedented for everywhere in every lending market to be taking this route. I mean, there may be exceptions, but largely speaking, lenders yesterday and still today, and probably we'll get into some of the things that I talked about with the lenders, but probably for the next few months it's going to be like this. But you're not going to get well, what if I don't want to buy it down? What is my rate? They're going to say, we don't have one. That's not them being, I guess, intentionally confusing or trying to obfuscate any kind of end result there. That's just the state of the lending world right now. And so when I started talking to lenders and all that stuff yesterday, trying to get my own understanding, because I was like, hey clients, that sounds weird, I don't know what's going on, let me help you figure it out. So I'm calling people, I'm talking, and so from those types of people, the financing people, I'm hearing that because of the Fed interest rate hike up, which is the intention behind hiking up these interest rates is to assuage inflation, which, I mean, we're in an inflated market. Like, I don't know how we can keep pretending that we're not, or how some people can keep pretending like we're not, but to assuage inflation and to then also try to correct the home market. That is part of the reason why these interest rates are going up. And I shouldn't say that so passively. That is why the Fed Reserve continues to raise the interest rates over these last few weeks, and did it twice yesterday. So because they're doing that, what then banks are afraid of, I want to say it the flippant way first, they're afraid of you making money off of them. But said in a more technical way, as these rates increase, inevitably there will be a time to refinance. And so when you refinance, that's a benefit to you, not the bank. I mean, the bank, of course, still gets a check every month, if you're paying every month, but they're not getting as much money. So what banks are effectively trying to do is say, this is crazy. If the Fed succeed at correcting the market through this method of increasing interest rates, people will refinance, and then we'll be receiving less money overall. If there's this massive refinance, we're not going to have as much money as we originally thought, because that's like the whole point of refinance. In the home correction thing, they've basically decided, they being the lenders have decided, we'll try to get our money up front. We'll try to hedge our bets for ourselves by making you, the consumer, pay for a rate buy down. That way we collect some liquid capital, some guaranteed capital, in the event that everybody and their mom wants to refinance again and we're stuck with less money than we were really calculating on having. That is what's going on. What's crazy about this, of course, like I said, is the Fed's never really done this before. I mean, I'm talking to people who have worked in the industry for 20 years. They're like, we don't even know, we're still trying to figure out what's happening. We don't know what to do. And of course, these are real people. These are not people, these are not like CEOs that I'm talking to. So, they're just doing their job. All they can do, if you're looking to buy and you're frustrated with the situation, it's understandable, but please do not take it out on your lender. Your lender has to do what their institution tells them to do. They can't offer you something that the lender can't honor or won't honor. You'd be even more ticked off at that. So don't be frustrated with your lender, but lenders everywhere, lending houses everywhere, institutions everywhere are absolutely panicked about the idea of a market correction. They are unsure, of course, about what the Fed's going to do, other than a prevailing assumption that the interest rates will continue to rise, which, if you've been watching me for long enough, you know that I've been saying that they will probably continue to rise. So that brings me to, what do I think you should do? if you're moving here to Kentucky, already live here in Kentucky, what does the market look like, buyer versus seller, all that kind of stuff. So number one, repeating this, I think that interest rates will continue to rise. I mean, at this point, you've got to buy down probably a grand or two just to get a 7% interest rate today. So we're at 7% interest rates, which if you've been hoping for 2008, congratulations, you got it. But knowing that, even though that's really, really like unsavory of an interest rate, still historic lows. You know, people love to talk about the good old days, and some of those days were days we had 17 and 18% interest rates. I wasn't alive yet, but many of you were, and so 7% is still really good. Number two about that 7% is you're probably going to have some time between getting a 7% interest rate locked in and the time before you sell your place again. If you were to move again, you'll have a time to refinance. So get the house because 7% today is much better than 9% 6 months from now. And I'm just saying 9% because I've been reading a lot and it's a number that I see a lot. I don't know how fast that'll happen, and who knows, I could be wrong, but people much smarter than me are predicting that we will continue to see interest rates rise. And so it would be much better to buy your home at a rate today than a higher rate tomorrow, next week, next month, next year. Because even if you do the math, I did a little example before this video. Well, before I say that, I don't think prices are coming down. Again, this is in Kentucky. You might live in New York. I ain't talking about New York. I'm not talking about San Francisco. I'm not talking about Texas. Here in Kentucky, we've had an inventory problem long before COVID was ever uttered on the lips of anybody, okay? We have an economy that is not built on commercial real estate, like a lot of the larger cities that are out on the coast. There are a lot of reasons why I don't see prices coming down, and certainly not coming down to the levels of 2008, okay? So if that's what you're holding your breath for, don't suffocate. But even if they did, let's humor you. Let's say that prices came down, there was a market correction here in Kentucky for, let's call it 10%. So today, if you were to buy a house for $250,000 for 7% on your interest rate, you're talking about $1,300 a month, which over the lifespan of your house, which you probably are not keeping your house for 30 years, but over the lifespan, that's $529,000 that you're paying in interest. This does not include HOAs, this does not include taxes, none of that. This is just principal and interest. That's $1,300 a month, roughly $529,000 spent over the lifetime of your loan without any sort of refinance. If you get the little crash that you're hoping for, that I don't think is happening, that's $225,000. So like say we get a 10% just chop off here in Kentucky at 9%. Because again, I'm saying this 9% is just a number that I see with random stuff that I read from like economists and whatever, because it's my job to read. $225,000 at 9% is a $1,450 a month payment, $566,000 of lifetime interest and principal. Okay, so we're already at 2008 interest rates. We're certainly not at a 2008 economic structure. A lot of things could happen, but even if prices were to fall here in Kentucky, you're still going to pay more than if you had just bought today. That is my general stance. That's my platform. You can agree, you can disagree. It's your money. But what I see, what I read, the people that I talk to, all of whom are much smarter than me and who have been in the business longer, I take that information and then I come to a conclusion. The conclusion is buy the house today. And that's whether you're working with me or not. This is not about me getting paid, but I just think that you're going to be in an even tighter, more expensive and less comfortable spot in a year than if you buy something now. You'll have time to refinance, especially the longer you stay in your house. I mean, there's a lot of ways to get over the initial sting of this particular economic situation, or this economic environment that you're buying a house in. But inventory is getting tighter here in central Kentucky. It's not expanding at a rapid rate. I hope to see that change. I certainly hope to see that change. But again, there are lots of people moving here. We have an incredibly diverse employment base, meaning people that give jobs, that provide jobs. We have a very diverse group of industries that are here. We're not just one type of industry. So, we're not looking at, oh man, like where I'm from, the car industry is suffering. All of Detroit just like loses its mind. Like that's not here. That's not Kentucky. So again, like I said at the beginning of the video, if you're watching this and you're trying to figure out, well, what does this mean for me in, I don't know, Austin, Texas, or in Denver, Colorado? I honestly don't know. I'm not licensed there. I don't pay attention to the local real estate markets of a bunch of cities. So you'll have to ask someone else that can help you. I mean, talk to a lender, talk to a solid real estate agent that keeps a pulse on this stuff. But from a macro point of view, regardless of where you live, it looks like interest rates are going to continue to rise. And for the next few months, it does look like if you're trying to buy a house, you're probably going to be in a situation where you're going to be quoted a rate based on the amount of money you give to buy down to that rate. And that's coming again from lenders that I'm talking to. This is not like stuff that I'm imagining. These are projections from people who are originating mortgages and underwriting mortgages and things like that. Sellers, I didn't forget about you. I almost did. But what this may mean for you, I mean, this relates to the buyers too, but you may start to see more offers come your way that instead of asking for closing costs, are asking you to pay buy down costs. So like 3 years ago, before things got really, really crazy in the home market, it was relatively normal to get, some closing costs, if not all, paid for by the seller as an offering buyer. And then, COVID happened and all sorts of things happened that accelerated a lot of the issues that we were already having in various home markets, certainly this one. And it was like, yeah, we're not paying closing costs. That was a non-starter. But now, because yet again, there's so much umbrage on a buyer, and now that it's like a systemic sort of weight down on buyers, it's something that it might end up being a seller problem too. People may be asking you to buy down points. And if you're a buyer, I would encourage you to go ahead and ask. Asking someone to buy 4 points down on your mortgage is A, going to cost a lot of money, and B, may be something really ridiculous to ask for. But, you might be able to ask for a couple grand so that you can get a more favorable rate going into your mortgage before there's a more advantageous opportunity to refinance down the line. So rate buy downs may be your best foot forward buyers. That depends on what kind of house it is, how many offers, what location, even here in central Kentucky, because the demand to be in certain places is not equal across the board. So I mean, that's going to be very, very germane to what you're offering on and what the circumstances are around that offer. But rate buy downs, asking for those from the seller may be a really good option for you. And sellers, it is likely that you're going to see it. Whether you accept that kind of offer is, of course, unique to you. That's your business, but you're probably going to see it more because people are paying appraisal gaps and all sorts of things. Like, buyers do not have endless money. There's a limit, and so this tug of war, I guess, continues, and it's not super fun really for anybody. But I wanted to make this and update you all about what's going on because it matters. I mean, whether it's land or a home, it doesn't matter. If you're borrowing money, it just got harder for you to do so. That's really the bottom line. And if you're trying to sell, either you're gonna have to be more patient. If you're a person who's gonna sit and say, I'm not giving up, I'm not giving anything, I'm not giving in on anything, you may be waiting, because most people are financed buyers, and people don't just have tens of thousands of dollars for their down payment and an appraisal gap to pay when appraisals are short and rate buy downs now. That's a lot. That's a lot. So go forward, hopefully understanding more. If you have questions, comments, please put them down in the comment section. I will be doing an actual third quarter market update for Central Kentucky soon, but it is September 27th and the third quarter is not over. And so I want to make sure that I at least have all of the data from all of the days in the third quarter before I go ahead and start telling you what that all looks like. I think that's all I've got for today. So adios.